Bill, you look at the report today from the FOMC, really nothing that's changed much. It seems like they're just willing to stick by and continue what they're doing. Is there anything here that's exciting to you?
Oliver, I hardly ever want to change the things that you say, but in this case, I think I'm gonna have to correct you.
Okay.
There was something different about this statement, and
Walk
it's really a nuance. The open market purchases of securities was initially for calming market conditions and maintaining market stability. They've now shifted and said, we're going to continue these purchases until we make progress on our goals of price stability and full employment. That means it's going to be in for a much longer period of time than just calming the markets. So that's number one. They really have given the markets a signal that we're in for the long haul here. Don't even think about us doing anything to hauling things back on financial conditions. And number two, I would say that your assessment of the speculative frenzy in markets. I think you said, well, Bitcoin is going up, whereas NASDAQ is not. I think if you really look carefully at the components of NASDAQ that are apples to apples comparison with Bitcoin, you would look at Snowflake, you'd look Palantir, you look at Airbnb. These are the openings of the new economy that investors are investing in because they know the post-COVID environment is going to be much more remote, much more pick your room as you go, and you pick not through a hotel, but through private ownership. And so these shifts in the economy, whether it's internet-related technologies or travel-related technologies and hospitality technologies, these are where the comparables to the Bitcoin investor is going. So if you take the indices and sort of rearrange them a bit, I'm willing to bet that an index of these new IPOs plus some of the new economy stocks like even Amazon, right, would give you a run for the money for the Bitcoin increase.
And at the same time, we've got, basically highs. We're going to close out at a high. If we stay right where we are in the NASDAQ, it's going to be a high. BTC's at that high. To kind of connect the policy with the markets here, Bill, does the message that the Fed sends right now, is it, in your mind, enough to provide that floor for these extreme valuations and the types of companies we're talking about here? Because we've been through a decade in which rates only went downwards with the exception of two brief moments. And the Fed was not just supporting, but they were, for the most part, adding on, again, apart from a few brief moments. So is that different at all? Is this as accommodating an environment for dot-com style valuations?
For our investor audience, I think the Fed is trying to reassure them that they're not going to pull the rug out from under them. So yes, it is providing the floor for the valuations of these dot-coms. And it's really up to the markets to sort out what the appropriate valuations are going to be. But it's not going to be one of not having enough financing. And so that's what the Fed is trying to reassure you. I think the other thing to remember is that the Fed has been a sideshow. It's a sideshow to fiscal policy. And all the Fed's been able to do is to make sure financial markets are functioning. The one thing they're not able to do is to get the money to where the money has to go, which is to people who are unemployed, to the businesses that are going bankrupt, because the businesses are going bankrupt and the unemployment is rising because of lockdowns, administrative lockdowns caused by health policy. And that has nothing to do with financial markets, nothing to do with financial conditions. So the Fed realizes that it really should not be flooding the markets with so much liquidity that it overheats the real estate market, the car market, and all the consumer durables out there, because that would be making a policy mistake. And so they're trying to draw a very fine line between being a sideshow and today they put a second act on this sideshow to say that we're in for the long haul. We're not going to be hauling things back until the full employment is reached and we have price stability. So I think those are the nuances that you have to keep in mind. And I think Chair Powell has been very successful in a press conference in explaining we are here to support the economy. It's up to fiscal policy to give the people who are in distress and businesses that are in distress economic support, and they should get off their tail and do something, because that is the primary policy initiative that's needed right now.
Bill, I love the details here and the fine prints. I will say this, though. What I've seen here over the last, call it 4 months when we talk Fed, guests and I generally is, it seems to be getting increasingly kind of academic and minuscule in terms of the changes. In terms of market impact, who didn't think that they were going to do this? When Jay Powell in August said that they were going to let us run hot, the average inflation target was like, okay, they're on cruise control. We know they're not going to touch anything until we get even close to that. It feels like they're kind of finding new ways to say just slight deviations of what they've already said. Is any of this going to stop a 4-month sell-off in treasuries? Is any of this going to slow the rate at which the yield is climbing as we emerge from this crisis?
Oliver, we've known each other for years. I know you back to your Bloomberg days. And as you know, when I was chief economist at Citi, I had to make sure that everything I said was meaningful. And right now that I'm out of the business and I'm working for
I like where this is going.
I can honestly tell you, I chastise my colleagues for making a big deal out of nothing. And to say that, oh, we're going to do some Operation Twist or some other things like that to get maybe a basis point on the 10-year, that's ridiculous. The Fed has been a sideshow for months, and they should just tell the audience, just cool out and chill and look for where the new economy is going. Put your investment dollars into where you think the economy will thrive in the future, and leave the Fed alone, because the Fed knows what it's doing. It really is sitting by the side and just ensuring that markets are going well. The one thing that our colleagues should have said, and more press should have said, is the Fed totally screwed up in the lending program because it was not able to get money to the businesses that needed it. And instead, it wound up with a pile of money in its lending fund that Treasury took back and said, hey, you're not using this. You can't let this crap out. What is wrong with you guys? And the Fed says, look, it took a lot of work on our part to figure out who is able to borrow this money and pay us back. Well, that's not the purpose of that fund. That purpose of the fund was to give support out there. But unfortunately, the Fed constitutionally cannot lend to people it doesn't know it's going to pay back. And that was the misdesign in the program, and the Fed should have admitted that it's not up. Change our charter and let us lend to speculative businesses and let businesses shift their operations to a post-COVID environment. And that failure is something that my colleagues and every economist should be banging the table and say the Fed screwed up on lending.
So, Bill, I think what's interesting here is we've got a conversation about what they've done, how we've learned the way they communicate to markets as being a very important piece of this. But going forward, how do we know kind of what the response in the data in the markets is going to be for a pandemic emergence, right? I mean, we can kind of go to other cycles and say, okay, they got to look for these things. But this is where I think there may still be that possibility of surprise where we don't really know, right? I mean, they say that they're going to let these things run hot. They say that they're going to stand by until these measures are reached. But it seems like right now they're not taking any information about, say, a vaccine progress. There's not a lot of that talk in this statement. There's more talk about the problems than there is the progress over the last 6 months. And hasn't it been huge progress, the fact that now we know that when we are going to beat this thing? And 6 months ago, that was still a possibility that maybe there wouldn't even be a vaccine.
Yeah, Oliver, this is why I really like being on your show, because you really get to the heart of it, which is to say that this is a health-induced recession. It has nothing to do with financial policy. It's nothing to do with economic policy. And we have to, and the only part of history we should go back to is the 1918 flu, the SARS outbreak, and some of the Ebola outbreaks, and learn from our lessons for how it is that pandemics and epidemics spread and what it takes to calm them down. And I think those are the historical lessons we should be looking to, and not look at business cycles and as our old economist friends do, right, to say, oh, the typical recession is this many months to get out of, and we've done it historically fast. Well, no kidding, because nothing broke down except the fact that government locked us down and prevented activity from carrying on. So let's get over this notion that we can look at past cycles as a guide. We cannot. We can look at past health cycles as a guide. We can look at past epidemics as a guide, but don't give me this crap about business cycles.
Hey, Bill, one other thing here. Any thoughts on which data point or which metric could be potentially the most fast moving in terms of signaling the pace at which we're coming back? If there is this kind of, I don't even want to call it tail risk. It seems like it just is still that one risk out there that, okay, things do actually come back pretty quickly here. What do you look for? Is it just the high frequency jobless stuff? Is it foot traffic? Is it actually, because it feels like maybe watching inflation is going to be a little bit more slower moving. Is that going to actually be something that gives us a quick heads up?
Be careful to distinguish between inflation and price level jumps. I think that's the big mistake that everybody seems to make. We're going to see a lot of price level jumps because of supply constraints once the economy comes back on again and people start demanding services. They're going to be long queues and overbooking of a lot of hotel resorts. But that won't be until, I think, 2022. The one thing we should look for immediate problems in the recovery path and changing forecasts are screw-ups in logistics of distributing the vaccine. Already we heard shipments of the Pfizer vaccine. In fact, to go back to Pfizer, because they discovered that the vaccine was being carried in a plane at too low a temperature. They thought that may have somehow destroyed the efficacy of the vaccine. Those are the kind of difficulties that we should keep our eye on. I really don't give a lot of credence to the weekly unemployment claims and all the usual economic data that my fellow economists are looking at, because, as I said, this lockdown-induced recession is because of administrative policy, nothing else.